This video is for educational purposes only and is not financial advice. The speaker's opinions should not be considered as advice from a licensed professional. Viewers should not use this content as a specific inducement to make investments or follow strategies, but rather as an expression of opinion. Follow the rest of the disclaimer, but please do your own research. What up, Tycoons? Welcome to Tycoon Network, where we specialize in trading stock options and providing stock market education to help others achieve financial success. Now we have TNX and IRX here, the yield curve. That's what I use to, kind of track the yield curve. I honestly think that a recession is coming or starting around November of this year. It might not be called out until like beginning of next year, 2025, but in my opinion, it's going to start the decline this year, and I'm going to tell you why in this video. So we have the uh, TNX and IRX. IRX is this actual purple line right here. So that is what we're going to look at when it comes down, and the candles are actually TNX. So when that comes down, that uninverts the yield curve. Okay. So when that happens, you see we have a recession that happened on March 2001. But you see way over here in 2000, we already had that. This is the weekly, by the way. We already had that bearish divergence showing us that we were going to have a decline, and then IRX uninverted, causing, being one of the causes of a recession. Same thing happened in 2008. We had that early bearish divergence, and then, because as you can see, that's, double top right there, and then it uninverted right there. Boom, recession around November of 2007, starting the 2008 recession, which we call the Great Financial Crisis or the Great Recession. Okay. Then we have 2020, which started around February, but you see way before, 2, 3 years before, we already had the bearish divergence right there. And then it started the decline, and then the yield curve uninverted. Okay. So similar to over here, we already have this bearish divergence right here, but it's also making one right here. So way back here, like 2 years ago, we already had that bearish divergence showing us yield curve is still not uninverted. In my opinion, it will uninvert around November. I can't pinpoint it, but it's, might be a little after that, a little before that. But in my opinion, it might be the week of like, November 14th or something like that. Also, we have the bearish divergence on the RSI down there, which is really, 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 really prominent. Okay. Because the same thing actually happened before the 2008 crash. As you can see, we have that bearish divergence on the RSI. All right. Same exact thing happened. And then we started crashing for like around a year and a half or something like that. All right. For 2008. So aside from just the yield curve, okay, we're looking at HYG here. HYG pretty much is smart money. And I have the recessions and corrections kind of notated here. Okay. So you can actually see this is the Great Recession right here. That was 2008. Then we have a correction right here. Then we have a correction right here. Then we have a recession right there with 2020. Okay. Then, interesting enough, right here, 2022, it was supposed to be a recession. Technically, it is classified as a recession, but they changed what a recession is. So it's not a recession. Okay. So that would be technically a correction. Okay. Now we have the, as you can see, the 71 65 area where things bounce at. But what I really want to show you is down here. It shows us with divergences again on the weekly chart exactly when we're going to drop and pop during these corrections and recessions. So you see during the Great Recession of 2008, it showed us a bullish divergence, letting us know on HYG, smart money was letting us know ahead of time we're about to basically go bullish again. All right, we had that bearish divergence right here, led to the correction. Bullish divergence led to the correction being over. Okay, same thing over here. Bullish divergence led to the correction being over, and same thing over here in 2020 had that bearish divergence right there, leading us to have an indication that we're going to have a big decline, which we did have. Same thing happened right here in 2022, had that bearish divergence, and then shortly after that led to that decline. After the decline, You see, this is higher low, lower low, but right here we have the bullish divergence letting us know that we're going to start popping. And popping we did. So what's happening right now is we have the bearish divergence on smart money right here, as you can see. And HYG is letting us know that we could and should see a decline. How deep the decline will be, not sure, but this once again is me thinking that this is a possible start of us, having a decline that's showing us that we should have a correction or a possible recession. Now, if we go to the next one, you'll see the unemployment. Okay. So unemployment with the Federal Reserve, unemployment, the federal unemployment, it's 2000 right here with the recession. To me, when we see this little uptick, that usually leads to a recession when we put it on the line chart. So when we see that little uptick right here, boom, same thing happened in 2008. That happened in 2000. Now we're looking right here. This is flat, right? But then when you see right there, that's a little uptick right there, which led to 2020. And right now, you see the question mark right here. Not sure if we're going to have the same reaction, but as you can see, every time we see that little uptick right here, and right here led to a recession. Now it's been declining. You see, it's been declining, and then you have that little uptick that happens after that. So it's been declining, been declining, been declining, and then you have the little uptick, recession. This has been declining, been declining, been declining. You're starting to see that little uptick, which, in my opinion, I mean, if it walks like a duck, talks like a duck, three times it happened before in three of the biggest, recessions. I don't know. Might be something to look at. So aside from that, we have uh, XHB. Now, a couple of the factors that led to the 2008 recession were like a subprime mortgage crisis, where the housing bubble, it was fueled by like a subprime mortgages, and it eventually burst, and it led to a massive defaults and foreclosures. So I see that same thing happening right here, but maybe not in the same way. I want to kind of point a few things out though, because we had a lot of, people grabbing homes in 2021 when we had the lowest mortgage rate in history. Never happened, but a lot of people might be underwater in the mortgages, and there won't be any equity because if there are more homes on the market, then you're going to have to lower the price on your homes. Your home value might go down depending on where they got it at. If they paid over for it, if they overpaid for it, like a lot of people are doing, then they might really be, basically underwater. So what we're looking at right here is XHB. It's the home builders ETF. It's the S&P home builders ETF. Now, looking at this as an indicator, we have a bearish divergence right here. And you see bearish divergence, it led to a decline, which was an early indicator for the recession for 2008. Okay. So that started, as you can see, in 2007. Okay. Now, that was in 2007. When we look now at what's happening right now, exact same thing. Bearish divergence, clear bearish divergence, right? I have the price targets already listed at 81.50 and 59.20, but we already have a decline that's starting. And in my opinion, that is going to continue down this way, which is an early indication that, things are not going to be good later on this year. All right. Because as I want to point out in the last slide, it did start around the same time of year that this is starting. All right. Around the same time of year, around here, and then started the decline, which began around, excuse me, I'm using my mouse on my MacBook, around December, all right, of 2007. It didn't get announced as a recession until spring of 2008. Okay. So might be a little early on this, but if you can catch the top, might not catch it. Not only that, but another indicator that we were going to have a recession in 2008. Credit default swaps and derivatives. So um, AIG is they were heavily involved in like credit default swaps, and that kind of magnified the impact of the housing market collapse that happened in 2008. So when we're looking at this right here, I kind of want to point out 2000 and 2008. I want to point out like some historical stuff. So we had a huge incline right there, and then you see it kind of broke trend right there, popped back up, which could have been a retest. Boom, came down, led to recession in 2000. Right. Also on the RSI, clear bearish divergence, clear, clear, clear. All right. Now, what happened in 2008? 2008, the exact same thing happened. You'll see that bearish divergence right there, leading us to decline and boom, recession 2008. Now that started once again 2007. All right, ahead of the curve. Now let's look at 2020. All right, 2020, same thing. Bearish divergence on the RSI, clear uptrend. So when the bearish divergence happened, it was right here, clear bearish divergence, right? Clear, and then decline into recession. Okay, 2020. Now, when we look at 2024, if it walks like a duck and talks like a duck, so boom, huge incline. We have break of trend right here. It broke the trend line already. All right. And then the, moving averages are already turning down, but also we have the clear bearish divergence right here. You see that? Same thing that happened last time. Boom, clear bearish divergence right there. And then we might see an uptick and then down, which would lead to us being in a recession around the end of this year. Okay. Now I want to point back out how that happened on each of these examples. Okay. So to this year, it's an early indication that, you know, that's probably what's going to start happening with you seeing more houses on the market and more for sale inventory and more people that can't handle their mortgages because they got their mortgage when it was so high, and then when Fed rates get cut and they might want to refinance but they can't because they paid too much for their home. It's a lot of people that might be in foreclosure or just be underwater. You never know. I can't really point out why this might happen, but the technicals say AIG is going to drop. All right. And they say that when AIG drops, it normally leads to, recessionary or, climate. So aside from that, we want to go to XLF because another leading factor in what caused the 2008 crash is bank failures and financial institution collapses, right? Now we've seen a lot of that over the years. We've seen, a couple of banks that caused a few bank runs, and they said they got it under control. In my opinion, maybe some more regional banks, they say like 64, 65, but I think the smaller banks are going to just go under, bigger banks are going to eat them up. But major financial institutions such as like the Lehman Brothers, they failed, which caused widespread panic and credit market freezes, leading to the 2008 recession. Now, when you look at credit, it said credit market freezes when you look up Lehman Brothers and what caused it. So my thing is credit right now is, I mean, it's at the high, it's at an all-time high. It's at an all-time high. Credit defaults, credit usage, all of it is at an all-time high right now. Similar to financial situations in 2008. So when we look at this, simple, we have straight across right there, double top, but we have a bearish divergence. The bearish divergence led to us seeing, oh, huge decline. All right. So we caught it right here. And then if you would have caught it right here, which is actually around June of 2007, it just kept declining for the next year and a half. All right, leading to 2008 recession. Okay, So that happened in 2007. That leading indicator was the bearish divergence on the weekly chart. Now let me show you what's happening right in 2020. Okay. 2020, same concept, straight across, but the RSI is showing that bearish divergence. We go straight down. All right. What happens? I don't know what, happens around this time to lead to us having that bearish divergence, but I do know that this was around the time when COVID happened. But when you look at the technicals, it was already telling us, the bearish divergence was telling us ahead of time prior to any of that occurring. Okay. So when we look at the next slide and it's now like 2024, we see straight across, as you can see, and then we see a clear bearish divergence. What is happening? What is going to happen? I don't know, but it's a clear double top as well. All right. So even if I don't go just by like elementary patterns of like a double top and I just say, okay, I'm looking at the bearish divergence and that is letting me know, oh, wait, hold on. We might have a huge decline here. Yeah, I'm looking at a huge decline. Actually, my target is around $22. I know it sounds extensive, but in my opinion, if we just continue to drop for the next year and a half, 22 might get hit, pretty easily. Super cheap, super cheap, trade to use as a hedge for if things, start to crash. So this is what I wanted to show everyone. If we go to the wider view of XLF, it shows you actually what goes on 2008. You'll see the same thing. Boom, bearish divergence, huge decline. 2020, bearish divergence, huge decline. And then currently 2024, stupid bearish divergence right there, even on the stochastics. And we could see a big decline to around $22, in my opinion. So that to me is why I feel like we are going to head into a recession at the end of 2024 because three or more, but at least three of the leading factors that led to the 2008 recession right here, three of the leading factors are showing themselves again, and it's not looking good. So we want to prepare for that. And happy trading because I will be in the Discord showing, a couple of things that we can do to be okay when all of those things happen, if all of those things happen. All right. So happy trading.
Don't forget to join our exclusive trading and investing community where we provide a blend of technical analysis and cutting edge AI technology like AI powered stock predictive flow channels. We have the crypto alerts for breakouts. We have the stock option call outs by AI. They even give you the strike price and the expiration, along with several other features. We also have the trade suggestions from ourselves, the stock suggestions, leap suggestions, call outs from ourselves, economic data updates, and much more. Make sure you click the link below to join. Here's some of the profits from our trading group. We have from 20% all the way up to 4,000%. Now that's an anomaly, but we also have a couple 100% right here, 500, 160 right here. We also have 50%. So we look forward to seeing you in our trading group so you can get some profit as well. Also, whether you're an expert trader in need of a little help, or if you're a novice and you've never traded before, you want to get our accelerated trading course just for $19.97. We have 3 sections in there: foundation, framework, and finishes. Also having a bonus section with a lot of material that can help you with the investment journey, and it comes with a few ebooks. So this keeps it really simple, hones in on how you can make money now and in the future in the market. So this is really essential if you want to learn and grow. So accelerated trading course, only $19.97. You want to grab that. Make sure you join our free newsletter, The Tycoon Blueprint. Invest smarter, grow faster. All you have to do is click the link below and provide your email to subscribe. Lastly, if you or someone you know is interested in futures trading, click that link below for Apex Trader funding and the promo code. Input that promo code for 80% off. Now, if you don't have a ton of money, you can get access to between $25,000 and $300,000 per account. All you have to do is pay a small monthly fee, but with the promo code, you'll get 80% off. If you get 20 accounts For $300,000, that's $6 million in trader funding. And all you have to do is pay $2,000 a month. So you get access to $25,000 for your first withdrawal. And after that, you'll get 90% of the profits that you make. So once again, click that link below, put the promo code in, start trading now.